Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here, Curtis Gunn. Jumping into the charts on this December 27. So the new week has begun. It is a shortened trading week, so let's just keep that in mind. Typically, there is a little bit of a holiday light volume hangover as we're still kind of exiting the Christmas period holiday season. So I'm anticipating that the volume is still going to remain light in the overall indices, and that's certainly what we've seen. But nonetheless, the S&P was down today. The big thing that was down was tech. I still think that we're coming to fill this technical gap at 372. And then eventually there's even this larger one that has this fake print down here. This was actually never filled going all the way back to October. So I do think that this gap fill at October is going to be the minimum downside target that we can achieve in probably the next, say, within the next 2 to 4 weeks. Overall, why I think there's going to be downside in the market, if we simply look at the US 2-year yield, it is slowly trying to float up and recapture this original neckline. So if we do get a close above this 4.44, this topping formation is negated, and it means that you should be very bullish on interest rates rising higher. And that certainly makes cost of capital more expensive, which inherently is a headwind for stocks. The more impressive yield market is the long end yields. You can clearly see that you were in this downsloping parallel channel. You hit your support, pivot to your breakout zone, you retrace your support here, and you've broken out. You have recaptured this original neckline on the US 10-year. The big question is, if we get a positive close tomorrow, then again, this is a failed topping formation and likely means we head lower. With that understanding in mind, if we look at the US 20-year yield, the 20-year yield is very intriguing because we actually just started picking up some bonds. I still think that maybe you get this gap fill, also this 50% retrace, and then potentially you may get a retrace all the way back up to this upsloping trend line. But one of the reasons I wanted to start accumulating bonds is because picking up the UBT, we sold it all the way up here. Now we're starting to accumulate a position at this 50% retrace level, just a pierce of 25. I do think that we should see an inevitable bounce in yields at some point in time, and it's just kind of moving more defensive. If we do go into a deflationary scenario, we have the bond scenario where interest rates will fall sharply, and that should put our bond plays in the money significantly. So if we look at US oil, WTI chart is very intriguing because you can see you're hitting this resistance, major pivot, your intersection with no confirmed breakout, but you did confirm the breakdown. Now it looks to be that you're retracing, you've hit that level, and you've actually put in a little bit of a doji candle. So perhaps you're running into some short-term resistance, which means that if you fail to recapture this line, you could inevitably head down to the next support around 77. If you start to lose that, you'll likely test this 74 range, and then inevitably this upsloping trend line, which we've bounced off of over here, over here, over here. And one thing about the fourth hit of a trend line, usually when you hit a trend line or level 4 times, it is notorious for breaking. Typically when you have 3 major bounces, which we've kind of have off of this trend line, this trend is very, very weakened, especially if we are taking into the account the major trend, which is to the downside. Let's take a look at natural gas. Natural gas is interesting as well. Natural gas is basically consolidating now bearishly. I would still love it if we could get a retrace out of this 530 or even better off to this neckline around 590. That's kind of a little bit of a long shot, but the fact that you're now consolidating here on the daily chart for natural gas, it does not really make these two support levels that intriguing of a potential long play. I'd have to consider moving that level down a little bit lower, maybe to about this 439 level, where it would start accumulating. If we start to consolidate bearishly, I may consider opening up a short just due to the fact that we have broken and confirmed below critical levels on the natural gas chart. Let's take a look at the dollar. The dollar hasn't really caught that bid yet. It's kind of in this wedge pattern. You can see this downsloping, this upsloping. Wedge patterns, downsloping wedge patterns are notorious for breaking to the upside, so it does favor a likely move to the upside. If you actually look what we're doing, we're making a series of higher highs, but no higher low yet. So as we approach the apex of this triangle, which does coincide with that important economic data with the initial job loss claims on the 29th, perhaps if that data comes in stronger than expected, we may see a pop in yields and a pop in the dollar in the very short term, which is kind of why I'm a little bit more bearish on this market. Let me just see if there's anything we can touch base on. Let's pull up the Bitcoin chart because it is pretty intriguing. So Bitcoin is trying to put in this micro bullish pattern, just like we had a little micro bullish pattern here which failed. You're now trying to put in this micro bullish pattern over here, but considering this one failed and it actually had more of a better bullish consolidation with a breakout, considering this one failed, it's very likely that this one fails as well. And you can actually see that I'm watching this key area. There was some interesting intraday price action. This intraday candle over here was on extremely high volume intraday, especially if you look at the 10-minute chart. So what I observed during this intraday action, there must have been a miner or a fund or some big entity liquidated very quickly, because I remember watching this. It was a quick drop reversal and then back up. But this range connecting the 16.9 all the way to the 16.718 is all your inside bar bearish consolidation. And notice how those two upper levels were your resistance, again, your resistance you failed to confirm above. So anything basically trading in that range is considered bearish. Considering you've broken that red line over here and had an almost picture perfect retrace, that just makes me even more bearish on the intraday action of Bitcoin. Considering that all patterns are pointing to lower price action, I'm favoring a sharper move in Bitcoin on the near horizon. I do think we're going to get a move down in Bitcoin fairly soon. So if we touch base on Tesla, Tesla is very intriguing because once again, Tesla's having another double-digit down day, down 11.4%, and actually even more in the post hours, taking it down to 107. So Tesla's just had a fall from epic proportion. You know, a lot of this maybe is margin call, a lot of this has to do with the macroeconomic backdrop, perhaps Elon. There's so many rumors, but the fact that we have sliced through technical support, you can see this beautiful channel that we've been watching for quite a long time. The amazing thing is that this large weekly head and shoulders formation is now almost completed the downside move. The downside target of this head and shoulders takes you all the way to $100.82. So the fact that we're about $5 or $7 away does not leave much more downside until this major topping formation is complete. And perhaps we have to fulfill that downside before we get a major technical bounce. But it's very rare that when you hit a multi-week level of support, especially when you had multi-weeks of consolidation, it's very rare to just slice through that level without any technical bounce. This is why I do believe that once we fulfill the downside move, wherever that may be, I do think we're very, very close to a bounce in Tesla. We should see a snapback. When you're trading this amount of volume, 207 million shares almost on back-to-back daily candles, that is an exceptional amount of volume. Typically bottoms are formed near the when these volume spikes happen, and considering the volume on Tesla today and over the last several trading sessions, this volume has really been seen in a very light volume period in the stock market. So that is kind of the really interesting observation that I've made, is we've had exceptionally light volume in the stock market, but Tesla has been making record daily volume candles, not seen for a very, very long time. And typically when you have those high volume lows, that makes a very, very close capitulation bottom. So obviously we accumulated and added more to our Tesla. Our Tesla average is sitting at around 120.86, so there's still a great opportunity to get in. At the minimum, I think Tesla will eventually recapture this 137 mark, and even likely you could see this 165 mark on a bigger market bounce. I do think that we will eventually see a very, very large bounce. Once Tesla, all those sellers and margin calls and people fearing out start to panic, then we should see that snapback. And keep in mind, Tesla's still a very, very strong company, reporting strong earnings. Obviously still taking into account the the fact that they are cash flow positive. They don't really have too much, they don't really have any debt. So that, even though the cost of capital is getting more expensive in this environment, I do think Tesla's sell-off and fall has been a little bit overstated in the short term. Yes, there's still the potential that it could go even lower, even back to these pre-COVID highs. But I do think just due to the fact that Tesla has collapsed, even if you take it from where we were shorting, basically the November over here, you've had a 50% drop, or even without any bounce, you've had a 45% bounce without any drop. So if you had just to get back to even, you would have to have an 81% rally just to basically negate this 45% drop. So this is where the power of integers and percentage get really intriguing, because we are now poised. We could still have a 50% bounce back to the breakdown zone, and Tesla would still be down substantially on the year. So I do think that the zealous selling has kind of been a little bit overstated. We typically saw this with Meta. We saw it with PayPal earlier. So I do think we're kind of seeing a similar order and fashion of that. But when you're into these major parallel support channels, as well as multi-year consolidation periods, gap fill zones, retrace zones, time counts, the factors are stacking up in favor for a inevitable bounce. Let's take a look at silver. Silver's still just hugging the top range of this channel over here. I still think we have to see a consolidation period, at least probably back to this downsloping trend line, kind of a retrace zone before silver makes its big move up. This type of extension move on silver, even though you have had a consolidation period here, little periods over here, it's still extended, and it still likely needs to retrace back to major support before it can shake out the weak hands and stage another rally up. But overall, if we just look at the QQQ, so the tech industry, the Nasdaq was under substantial pressure today. You can see it was down substantially more. This was due to the fact that Apple was down, Tesla was down, a lot of the mega cap tech was under pressure today, probably due to the fact that yields were rising substantially, making borrowing and debt more expensive to service. But nonetheless, the Qs are very close to filling this gap fill over here. Again, this was never filled, this technical gap. It was a fake print. So I do think we get that gap fill around 259 probably fairly soon, based off of this sell side pressure. And if interest rates continue to go up, tech is likely to still see some more downside in the near term. Overall, that's it for today's video. Hope everybody had a wonderful holiday period and Christmas break, and we'll see you and hopefully guide you into some profits into the new year. That's certainly what we are looking to strive to do as we approach the end of 2022, which has been a stellar year for us traders and anyone who's been following the TC channel, as well as we look forward to trading and swing trading and day trading this 2023 volatility, because it should not, and I repeat, the volatility should not subside for quite a long time. Take care, everybody.